when we talk about accounting, we're really going to be talking about the accounting equation. And the accounting equation is fairly simple. We're talking about assets, liabilities, and equity. Now, before we can really do much, we need to understand what those things mean. So when we talk about assets, we're talking about the resources that a business owns. So the resources owned by the business. Liabilities are the amounts owed by the business. And then equity is the amount the owners have an interest in. So how much do the owners actually have as a claim to the business's assets? Now, the owner's interest in the business is made up of two things. It's made up of the amount they have invested and any amounts they have reinvested. And so when we start to talk about these things, we're getting into the idea that accounting is really about a language. If we don't really try to unpackage some of these terms, it'll be difficult for us to do much with accounting. So assets. Again, resources owned by the business. Liabilities. These are amounts owed by the business. And then equity. That's the owner's interest. Now, the amount invested in the business is what we refer to as common stock. And the amount reinvested in the business is what we call retained earnings. Earnings are another word for profits. And to retain something means to keep, right? So we're talking about kept profits here. Now, when we look at this equation as it is, it's fairly straightforward. Assets, liabilities, and equity. But it has some other components to it. So when we look at retained earnings, there are some things that feed into this. We have to talk about revenue. We have to talk about expenses. And we have to talk about dividends. Now, all three of these things tell us what our retained or kept profits are. Revenue is the amount we charge our customers for goods and services. Expenses are the costs we incur to do that, to get that revenue. And then dividends are any of the profits we distribute to the owners of the business rather than keeping them. And so here we have on the board the accounting equation in its entirety for the beginning of this course. Now, when businesses put together their financial reports, what they're telling the readers about, the story they're telling the readers, is the story of their accounting equation. So I don't want you to get away from the fact that this is going to be part of a story. And so we're going to look at the story for a business that might be a little bit unique. We're going to talk about Swamp Thing. Swamp Thing is a comic book character that I'm particularly fond of. But Swamp Thing is going to start a greenhouse. And his business is going to be called Swamp Thing's Greenhouse and Garden Gnomes. Now, Swamp Thing, being the entrepreneur that he is going to go around and provide a service to people who have gardens. And what he's going to do is he's going to clean people's garden gnomes. You know, these cute little guys like this, right? That inhabit everybody's gardens. This one's pretty dirty, right? It needs cleaning. So that's what he's going to do. Swamp Thing's going to clean people's garden gnomes. And after doing so for a period of time, at the end of his first year of operations, he has collected some information about his equation. So if you have the sheet that's on my website, we're going to be using this information right here, these numbers and these accounts. So we're going to build the financial statements for Swamp Thing, and we're going to talk about them. To start off with, the first statement that we build is called the income statement. So whenever we start off building a financial statement, we start off with the title. We have the name of the company, the name of the statement, and the time period that the statement covers. When we look at income statements, they are period statements. They tell us about what happens over a period of time. In this case, we are looking at for the year ended December 31st. And so this time period is January 1 to December 31. And in order to determine our income statement construction here, we need to know what goes on it. The income statement tells us about the profitability of a business. In order to determine profitability, we have to know about revenue. So revenue is the amount that Swamp Thing charged his customers for the services that he provided, all the garden gnomes that he cleaned. And so with our information, we see that he earned service revenue of $44,000. Now, in order to earn that revenue, he likely had to incur some costs. And so maybe he has some employees that he has to pay to help with this service business. Maybe he has some utilities he has costs to incur for utilities related to his shop or his storefront or whatever, his greenhouse. And so the next thing that we do is we take out of the revenues that he's earned the expenses or costs he's incurred to get them. And since we have more than one expense here, we're going to create a section for those expenses. And we list expenses typically in a particular order, and that is from greatest to least. And so in our account information, we have salaries and wage expense, which is $28,600. And we have utilities expense, which was $4,425. And so we need to know then what are our total expenses. And that comes to $33,025. So now I have my revenues of $44,000. I have my expenses, the costs I incurred to get the revenues, of $33,025. And so the difference between my expenses and my revenues is my net income. So in accounting, that's the word we use for profit. And sometimes it is called earnings. So what do we have here? That gives us a net income of $10,975. Now, you'll notice a couple of things here. When I did total expenses, I put a line above it and a line below it. And that is what we typically do with subtotals within accounting statements. At the very end of my statement, you see here I have double underlined the last number. That is our typical practice of formatting to show that the end of the statement has arrived. And so the question again is, from the income statement, the main question is, what was the profitability like for the company? Was the company profitable? And our answer would be yes. Their revenues were more than their expenses. The next thing that we do is we build a statement of retained earnings. The same thing happens here. We have the name of the company, name of the statement, and the time period. Now, these time periods should always match up with regard to your income statement and your retained earnings statement. The retained earnings statement starts with beginning retained earnings. What did you have at the beginning of the time period? In our example here, this is the first year that Swamp Thing had a business, and so we would start with retained earnings of 0. Then we want to know, well, how much profit did they have? Well, the net income for Swamp Thing for the year was $10,975. Corporations can do one of two things with these profits. They can keep them and reinvest them in the company, or they can pay them out as a distribution to the owners, or a mixture of the two. And so we see in our list that Swamp Thing paid out dividends of $100. That means $100 were distributed to the owners of the business, or withdrawn from the business by the owner, in this case if it was Swamp Thing. And so how much retained earnings were kept? Right? How much of the earnings were reinvested? Well, that would be $10,875. And that is what we call a retained earnings statement. Now, why does this have to come second? Well, what do you need to know first? You have to know your net income. Once we built the retained earnings statement, we can move on and build what is called the balance sheet. Now you'll notice with this one that it's a little bit different. We still have the name of the company, the name of the statement, but the time period here is just a single day in time. Because when we put together a balance sheet, we want to know what balances are in the accounts at a particular day. So we build the balance sheet like so. We start with assets. Now, assets are listed in a particular order. They are listed in what is called the order of liquidity. Liquidity meaning how quickly it gets turned into cash or used up. And so the first one that you'll see is cash. Swamp Thing had $6,000 in cash at the end of the first year of operations. The next item likely you'll see is what's called accounts receivable, AR. Accounts receivable represents amounts that customers owe the business. So Swamp Thing's customers owe him $29,750. After accounts receivable, you will typically find supplies. Supplies are things that get consumed in the production of the process or the provision of the service. So obviously Swamp Thing, if he's cleaning garden gnomes, he's going to need some cleaning supplies like some soaps and cleaners and things like that. So he has supplies of $4,000. Now, after supplies, we may have some other things like equipment. Maybe he has a truck that he drives around so that he can clean people's garden gnomes. And so he's spent some money on this truck, and so he's got $18,000 in equipment. One of the things you'll notice about your assets and companies' assets on their balance sheets is that they're always recorded and put on there at cost. So what does that mean? Well, we record assets at what we paid for them. So supplies, the $4,000, that's what we paid for the supplies. The equipment, $18,000, that's what we paid for the equipment. And so assets are recorded at cost. Now there are some other different measurement principles and techniques that you'll get to much later in your accounting studies. But for the sake of our course, assets are recorded at cost. Now, once you've found all your assets, then you can add them up and figure out what you have. We have assets of $57,750. The next thing on our balance sheet will be liabilities. Liabilities, again, are amounts that the business owes to other people. One of the most common is what is called accounts payable, or AP. Accounts payable is the amount we owe other people for goods and services that we have purchased. So if Swamp Thing has purchased goods or services from other businesses, then he may owe them for those goods and services. Accounts payable for Swamp Thing was $15,000. In addition to accounts payable, we may have notes payable. Notes payable are amounts that a business has borrowed from a lending institution in most instances and owes that money back to that lending institution and has to pay interest on the loan that they have taken out. And so Swamp Thing has a note payable of $735 remaining. And so we have all of our liabilities put up here. At this point, we can find total liabilities, which would be $15,735. Now, if you notice, I didn't double underline this one quite yet, because we're not done with this side or this piece of the balance sheet. The last part is our stockholders' equity. Stockholders' equity is made up of two things. You have the amount invested, as we talked about, which is common stock, and the amount invested in this business by Swamp Thing is $31,140. And you have the amount reinvested, which is our retained earnings. Now, retained earnings as of December 31st, we're going to have to pull from our retained earnings statement. And so our retained earnings at the end of December were $10,875. So our total equity, total stockholders' equity, is $42,015. Now, once again, as you see, I didn't double underline here because we have one more thing to do. We need to know what our total liabilities and stockholders' equity add up to. So we're going to take our $15,735 and our $42,015, and we're going to get $57,750. As we said before, the accounting equation. Assets have to equal liabilities and equity. And so we need to make sure that the total assets on our balance sheet, right here, match up with the liabilities and equity on our balance sheet, right here. And if they do, what does that tell me about my balance sheet? That it balances. And that's why we call it a balance sheet. Now, when you take a look at these financial statements, we have three of them. Three of the four general purpose financial statements. The income statement tells me about profitability. Was the business profitable? Yes, it was. The retained earnings statement says how much of that profit is being kept. In this case, we see that $10,875 has been kept. And then the balance sheet tells me about the resources, the assets, and the claims to those resources, whether it's the owner's claim or a creditor's claim to those resources. Who has the greater claim in this case? Well, the owner does. $42,000 of the 57 is claimed by the owners, and 15 is claimed by creditors. Now, we use financial statement ratios to analyze these, but for the sake of this video, I just want to talk about the communication aspect. Accounting is a language. Languages are used for communication. Communication. And we said it was about a story. What story is this telling me? Well, it tells me that it was profitable business, that they have 57 in assets, 57,000 in assets at the end of the period. The owners have a greater claim to those assets than the creditors, which is good. And that the profits that were earned were not exceeded by the dividends that were paid out. The company earned $10,975 in profits, and they only paid out $100 in dividends. But my question to you is, how much more could they have paid? Some of you might be thinking, well, hey, they could have paid an additional $10,875 in dividends to the owners. And if you were thinking that, I'm glad you were thinking that, but it's the wrong answer. Why is it the wrong answer? Well, dividends are cash distributions to the owners of the business. And you say, well, then why can't we pay out $10,875? Where did this come from? Well, we got to go backwards. We go backwards over here to the income statement. And that's where the $10,975 came from in the first place. Well, what is that made up of? Well, that's made up of my expenses and my revenues. And so let's look at these revenues. This tells me that Swamp Thing earned $44,000 in revenues from cleaning garden gnomes. I don't know whether that's possible or not, but that's what we got. So, $44,000 in revenue earned by cleaning garden gnomes. But we've got to take a look over here at the balance sheet to see what this is telling us. The second item on our balance sheet is accounts receivable. Accounts receivable, $29,750. Accounts receivable represents the amount that Swamp Thing's customers owe him. And so even though he's earned $44,000 in revenues by providing services, not all of his customers have paid him yet. Which means he has not collected all $44,000 in cash. He's earned it by providing the services and charging them, but he hasn't collected it yet. So what does that tell me? That tells me that net income is not a cash number. It's not a cash number. It's a profit figure. And we'll get into this more when we get into chapters 2 and 3. But it's not a cash figure. It's a dollar figure. But it's not a cash figure. And so if you look at a set of these financial statements and you don't understand this language, it's going to be really hard to interpret what's going on. When I lived in China, most of the people that I lived around did not speak English. And so in order for me to be able to communicate with them, I had to learn the language, right? I couldn't understand what they were saying until I understood the language. And that is exactly the case with accounting. Accounting is a language that we have to learn if we want to survive in the business world. And so pay particular attention to vocabulary here as you study and begin to study your first journey through the language and the business side of accounting.